Good afternoon, all. Hope you're all doing well. Hope you're having a lovely lunch break, and I hope we're not interrupting too much with that. And thanks for sacrificing your lunch to watch this presentation. So I'm Howard Clark-Burton, CEO of BMP Wealth. I'm joined with Jason Pierce, who's the head of technical sales for Hong Kong and Northeast Asia for Quilters, and he'll introduce himself in a moment. BMP, we are an independent broker in Hong Kong. We specialize in ensuring clients have enough money for the rest of their lives, whether they've got too much, too little, or just the right amount. The financial strategies all change. That's what we focus on, and most of that in these days involves cross-border issues, like people moving to the UK, Australia, all sorts of different scenarios. That's what we do every day. We're a Hong Kong-based company, and that's where our focus is. So today, as the order of the hour is, we were focusing on people moving to the UK or have plans at some point in the future to move to the UK. And we wish to share some ideas with people. We'll last for about an hour. Jason will go through some of the technical issues about the taxes, and then I'll go through some practical examples at the end. So please hang on towards the end. The end is where it brings it all home, and you can see the impact of some of the strategies. What I would say is everybody's situation is different. So these are just examples, and they can be tailored for each individual person. You can ask questions as we go, or at the end. You can use the chat button at the bottom, and we'll endeavor to answer them as they come through, or indeed at the end. So the choice is yours. And copies of this video will be sent to you afterwards. So without further ado, let me hand over to Jason. Just one moment.
Thanks, Howard, and good afternoon, everyone. Thank you for joining us. So, just by way of introduction, on the slides, if you see something that's in green type and bold and underlined, it means it's a technical term, which it might have a meaning which is different to its normal everyday English usage. On the next slide, I'll show you the first example, but whenever you see it in different colored type, just bear in mind that it's a technical term. For the purpose of currency conversion, I'm simply using 10 Hong Kong dollars to one pound sterling, and then some acronyms. So HMRC, that's the UK's equivalent of the IRD. They're the people that collect tax on behalf of the government. And then some taxes that we have in the UK that we don't have in Hong Kong, so capital gains tax and inheritance tax, and I'll talk briefly about them as we go through. So first thing to talk about then is UK residents. So Hong Kong tax residence is very simple. This is from the IRD's website, where it simply says if you spend 180 days of the year in Hong Kong in 1 year, or 300 days spread over 2 years, that would make you Hong Kong tax residents. In the UK, it's something similar. The first thing to point out that the tax year is slightly different, begins on the 6th of April and runs through to the following 5th of April. That's for historical reasons that go back hundreds of years. But just please bear that in mind. Now, residence, similar to Hong Kong, residence depends on the number of days that you spend in the UK each tax year. So you'll see there the word days is in green, bold, and underlined, which means that it doesn't mean a day in the normal English sense. What it means is being physically present in the UK at midnight. So if you take a flight to the UK and your plane lands at 5 to midnight, that counts as a day of residence in the UK, even though you're only there for 5 minutes. If your plane lands at 5 minutes after midnight, that's not a day of residence. So 10 minutes can make the difference between having a day in the UK or not. Clearly, you'll be there the following day, but it's been physically there at midnight. Now then, if you spend 15 or fewer days, in other words, midnights of the tax year between 6th of April and 5th of April, you are categorically non-UK tax resident. Anyone can spend up to 15 days in the UK in any tax year without becoming UK tax resident and therefore liable for UK taxes. At the other end of the scale, if you spend 183 or more days in the UK in any tax year, you are categorically tax resident for that tax year and will be liable for UK taxes. So what happens though if you spend more than 15 days but fewer than 183 days? Well, in that case, you will need to take something called the statutory residence test. So this was something that was introduced a few years ago to determine whether or not people were tax resident from year to year to year, because every year is treated independently and discreetly and separately. So this is an example of the sort of flow chart that you can do. It's a one-pager. It's available on our website. All the accountancy firms produce these as well. But you simply answer the questions. Takes 2 or 3 minutes. That's all. You go through the questions, and then it will tell you whether you're tax resident or not, depending upon your circumstances. So if you're somebody that's going to the UK and you haven't been tax resident in the previous 3 tax years, then at the bottom of the sheet, we're going to look at the right-hand side. The left-hand side is people leaving the UK. So now, if you haven't been residents in the UK for the past 3 years, you can in fact spend up to 45 days in the UK in a tax year and always be non-residents. Because you haven't been resident previously, you've got a higher number of days than the ordinary 16. Other end of the scale, of course, 183 or more, you're always going to be tax resident. But if you're more than 45, but less than 183, then it depends then on what's called your ties to the UK. So it might be that your threshold is 46 days, 91 days, or 121 days. And ties are things like, do you have a home in the UK? Do you have a job in the UK? Do you have family in the UK? So the flow chart that I just showed you will tell you how many days you can spend between the 6th of April and the 5th of April for a particular year, and it will determine whether you're resident or not, depending upon the number of days that you spend there. So what it means is, if you have a lot of ties and you spend 46 days of the tax year in the UK, it means you're actually tax resident for the whole of the tax year. So it means that you can actually be a UK tax resident before you go to the UK, because your tax residency could be backdated to the previous 6th of April. So this is something that you really need to be aware of if you are moving to the UK, because if you think you're Hong Kong tax resident, you're in fact UK tax resident, you could end up with a very nasty and unexpected and unnecessary tax bill. So we'll look at a couple of examples in just a second. So for that reason, it's always advisable, wherever possible, to organise your finances in the tax year prior to the one in which you're moving to the UK. Ideally, you should start to plan from a financial point of view about 18 months before the date on which you intend to go to the UK, which will give you time to organise your finances in the previous financial year, and that will avoid any unnecessary tax bills. Okay, so that's UK residents. In the UK, though, we have another concept called domicile. Now, most countries in the world only have residence and citizenship. They don't have this third thing called domicile, but the UK very much does. So residency, as we saw, is fairly straightforward, or it can complicate it with the 5 different thresholds. But that essentially depends upon how many days, midnights, you spend in the UK. UK domicile, or DOM for short, is a completely different legal construct. Okay. So it's different to permanent residency, it's different to citizenship, it's different to nationality. And I'll show you an example of how it works in just a second. There's no single legal definition of domicile, but very broadly, it's the country that you would have as your permanent home, even though you might not actually be living there at the moment, or the country with which you have the most substantial connections. It's the one where your financial center of gravity is. Okay. Now, everyone gets a domicile of origin on the day they're born. If your parents were married when you were born, you inherit your father's domicile. If your parents were unmarried or your father had passed away on the day that you're born, you will get your mother's domicile. So here's a real life example. This is a former colleague of mine. So Dimitri was born in London. His parents were in a long-term relationship, but they weren't married. His father's Russian and his mother's English. He grew up in the UK. He then moved to Hong Kong, worked here for a few years, which is where I met him. He's since left Hong Kong and moved to Australia. So because his father's Russian, Dimitri has got Russian nationality and a Russian passport. But because his parents weren't married, he inherited his mother's domicile, not his father's. He therefore has a UK domicile. Because he lived for more than 7 years in Hong Kong, he's got PR here, but he's actually resident in Australia. So Dimitri has connections with 4 different countries all at the same time. So this just demonstrates how domicile is very different to residency and nationality. Okay, so for UK tax purposes, everyone has a domicile. Now, if you've never had any connection with the UK and are never likely to, that's clearly irrelevant. But if you're joining this webinar, we're assuming that you're considering moving to the UK in which case it will be relevant. So if you've ever lived there or you're going to, if you own property there, if you were born there or one of your parents was born there, it will be relevant. Okay. Now you can only have one domicile at a time, but it can be changed. So if you're a Hong Kong person born and brought up here, you will have a Hong Kong domicile of origin. But if you go and live in the UK for a significant period of time, that can easily change from Hong Kong domicile to UK domicile. And remember, domicile is different to residence. Okay. Most Hong Kong people will keep their Hong Kong domicile for a period. Depends upon how long, how many connections you have with the UK, but this will have a significant effect on the amount of tax that you'll pay if you're UK resident. Okay, so if you are UK resident but still a non-domicile, a non-dom, there are some significant tax advantages which we'll look at. Okay, so if you move to the UK and you're UK resident, then you are going to have to deal with UK taxes. So the first thing to say is that the UK tax system is very, very different to the one here in Hong Kong. So the Hong Kong tax code is relatively simple. It's 276 pages long. Just for reasons of comparison, the Australian tax code, at last time anyone counted, was about 6,000 pages long, and taxes are higher there. In the UK, the last time anyone counted was 2015, and then it was 17,000 pages. Now, since then, we've had several budgets and other financial acts, so these days it may well easily be 20,000 pages long. But it's 17,000 pages, it's 10 million words. It's about 12 times as long as the Bible, if you're familiar with that book. And if you saw it printed out, that's what it would look like. Okay. The other thing then is there are different ways of applying personal taxes. So in the world, I've broken it into 4 different ways. The first and the simplest one is where there simply is no personal income tax. So probably the best known example is Dubai, where there is no personal income tax. They have other taxes, but you don't pay income tax there. The second method is what's called territorial, which is what we have here in Hong Kong and also in Singapore and Malaysia. Now, this is where Hong Kong will only seek to tax Hong Kong sourced income. So if you're a Hong Kong resident and then you have a bank account in Jersey that pays interest, that's not Hong Kong income. Hong Kong has no interest in taxing that interest from the Jersey bank account. But if you look at the map in the light blue, it's very unusual. You'll see the vast majority of the world is in dark blue, which is where it's residence-based taxation. Now, this is where if you're resident in any of those dark blue countries, you are subject to income tax and capital gains tax on your worldwide income. So if you're living in the UK and you still have Hong Kong income, that is going to be subject to UK income tax in certain circumstances. So they have the same system in Australia, worldwide tax, and most other countries. The fourth and probably the most comprehensive is the US citizenship-based tax, which was where if you're a US citizen, it doesn't matter where you live in the world, you're still going to have to pay tax back in the US. Okay, so some people say, well, why are the taxes so much higher in the UK than they are in Hong Kong? Well, it's largely down to the fact that the UK government spends a lot more money per head of population than the Hong Kong government does. So these are the actual figures here. I'm just going to show you again for comparison here. This is from the government accounts website. So I'm going to convert all of these figures into Hong Kong dollars at the end, so you'll be able to do it on a level playing field. So those are the figures there, 609 billion Hong Kong dollars for the last financial year. Australia does quarterly figures there. I'll add those up for you in a second. And then in the UK, and for the tax year ending in 2019, 834 billion sterling. Okay, so let's just put those on one chart so we can see how it compares. So that's the government expenditure from the slides I've just shown you. That's the last population figures that I can find as well. So let's divide the total government expenditure by the number of people that they're spending it on. Those are the figures there in local currency, and then finally convert all the currencies into Hong Kong dollars so we can make the true comparison. And you'll see there that Australia spends about twice as much per person as Hong Kong does, and the UK spends almost as much as well. This is because in the UK, we have a very comprehensive social security system. There's old age pensions that people get paid. There's sick pay, unemployment benefit, housing benefit. We also have free schools, free hospitals, armed forces to pay for. The government in the UK spends a lot more and therefore has to raise much more by taxation and also by borrowing as well. So let's look then at what taxes you will have to pay depending upon your residence and domicile. So I've broken it down into different types of taxes. So let's start on the first line. This is where you're non-UK resident and non-UK domicile. So you're a Hong Kong person living here in Hong Kong and you haven't moved to the UK yet. If you've got any UK income though, because it's UK sourced income, the UK will tax that. So if you've got a bank account in the UK that pays interest, or if you've got UK stocks and shares that pay dividends, because it's UK income, that's going to be taxed. Non-UK income though is not though, because you're not living in the UK, so they can't tax that. What though if you own a property in the UK that you're renting out and that's paying rental income? Well, that again is UK income, that's going to be subject to UK income tax. If you sell a UK property at a profit, you will have to pay capital gains tax on that. Now, this is a change that came in the UK in 2015. Prior to that year, if you were living in Hong Kong and you sold a London apartment for a profit, you didn't have to pay capital gains tax. And then they changed the law in 2015. So any profit on any property in the UK that's arisen since 2015 will now be taxed. So there's been 24 changes to the taxation of UK property in the last 9 years. Most of them have been increases. The other thing is, if the owner of a UK property passes away, that is also subject to inheritance tax at 40% of the value of the asset. Now, for non-domiciles up until the year 2017, they could get around this by setting up an offshore company and have the company buy the property. That way, if the owner of the company passes away, they don't own the property, they own the company and the company is offshore. But because the company still exists and it still owns the UK property, there was no inheritance tax. And then a very significant change from the 6th of April 2017, the taxman in the UK now will look through any offshore structures that own UK property and any combination of structures until they find the human being that actually really owns the property. And when that individual passes away, then the inheritance tax is applied. If you've got any other assets that are in the UK, so if there's furniture in the house or antiques or valuable paintings or anything else, or if you've got a UK bank account and you pass away, that's UK assets there subject to UK inheritance tax. But because you're non-domiciled and IHT depends upon your domicile, not your residence, then any non-UK assets, so your Hong Kong property, won't be taxed. So that's why you're living here in Hong Kong. Let's say then that you move to the UK and for the first few years, you retain your Hong Kong domicile. So you're UK resident, but not UK domicile. UK income taxed in the same way. The difference here is this: your non-UK income, so your income from Hong Kong, won't be taxed if you use what's called the remittance basis. And I'll explain a lot more about that in just a second. UK investment property, always taxed. UK assets, always taxed to inheritance tax. But while you're still non-domiciled, your non-UK assets, your Hong Kong property, and anything else outside the UK won't be subject to the 40% inheritance tax. Now, if your domicile changes, and I'll explain how that can happen, it's one of 3 ways. If your domicile changes from Hong Kong to the UK and you're resident, you will be taxed in exactly the same way as a native-born British person who's living in the UK, and you're subject to all of those personal taxes all of the time. Okay. So what is this remittance basis then? What is this advantage that you have if you're a non-dom, Hong Kong domicile person moving to the UK? So the first thing to say is that if you are in that position, you have the choice of 2 different methods of paying tax. The first is called the arising basis, and this is where you simply pay UK income tax, capital gains tax on your worldwide income and gains as they arise. In other words, the same way as a native-born British person would be. But if you're a non-dom, you have a choice of an alternative, which is called the remittance basis. So in this case, you still have to pay tax on your income and gains because everyone does. If you've got any income from outside the UK or any gains and you transfer those to the UK, and the technical term is remit, remember it's in green, and I'll talk more about what a remittance is. Any Hong Kong income and gains that you remit into the UK or from anywhere else in the world, then those will also be taxed because they've entered the UK and therefore the UK tax system. But if you have Hong Kong income that you don't remit to the UK, that is not subject to UK tax because it hasn't gone into the UK. So you can shelter all of your offshore income and gains from UK tax. So it might be you move to the UK and then you sell a Hong Kong property for a very big gain. If you send that gain in cash to the UK, that's going to get taxed. But if you leave it in your Hong Kong bank account, it won't be. This is the advantage that non-doms have. Okay, Now, each individual tax year, you can choose for up to 15 years whether you want to pay a rising or remittance. Now, you might think, why on earth would anyone choose to pay the arising, because I'll end up paying a lot more tax? Well, you have until the 31st of January following the end of the tax year. Remember, the end of the tax year is the 5th of April, so you've got a few months after the tax year ends to decide which is the best for you, so you can do all of your sums. Now then, for the first 7 years that you're living in the UK, there's no charge to use the remittance basis, so you get a freebie for the first 7 years. But then, from years 8 to 12 inclusive, if you want to continue with the remittance basis and shield your offshore income from tax, you have to pay. There's a £30,000 a year charge on top of any taxes that you'll pay to use it. So if in year 8 your offshore gains and income are only £10,000, why on earth would you pay £30,000 to have them not taxed? You just pay the tax on the £10,000. So, and then from years 13 to 15, it goes up to £60,000 a year. And then from the start of year 16 onwards, you'll be what's called deemed UK domicile. And that's basically they're saying, okay, you've spent enough time in the UK now to be treated exactly the same as a native born British person, and you can no longer use the remittance basis. You're going to have to do a rising and pay a lot more tax. Okay, so how can your domicile change, or how could it change? So there's 3 different ways. The important thing is if it does, or when it does, then you're going to end up paying a lot more tax. Okay, the first then is spending 15 out of 20 years in the UK, the deemed domicile. This is a simple year count. There's no argument about it. It's there. It used to be 17 out of 20 years, but they lowered the amount in 2017 to 15 out of 20. So that's what it is today. They could lower it again. They could say if you spend 12 years in the UK or 10 years in the UK, who knows? Okay. The second way is what's called having a domicile of choice, and that's where you've chosen the UK as your long-term home. Now, there is no single legal definition of this, but the most common one is to say you've either settled permanently or indefinitely in the UK. So you've started a business there and your children are settled there and so on. In that event, you obviously will then, that can happen way before 15 years. You might go to the UK and within 3 or 4 years, you decide, yes, we like it here. We're going to stay here. We're going to settle here, make it our permanent home and have more ties in the UK than we ever had in Hong Kong. Now, clearly that's going to change your tax status. And if HMRC, the tax people say, you've obviously settled in the UK, and you say, actually, no, we haven't, we're not quite decided yet, and so on. And if it turns into a dispute, which it often does, between the tax collector and the taxpayer, this can only be settled in court. There is no sort of, and you'll have to go to court and the judge will look at your case and decide. And the courts in the UK are busy every working day with judges deciding people's domiciles, because they're trying to say, we haven't got a domicile of choice, and the tax people are saying, yes, you have. Okay. The third one is called something called domicile of election. We haven't got time to cover that today, but that's broadly where it's a mixed domicile marriage, where one partner is a UK dom, one is a non-dom. And there are very good reasons that people would do that. The most important thing to say, though, is if your domicile is changing, either because you're coming up to the 15 years or because you have formed the intention to settle, as long as you plan in advance, you can mitigate a huge amount of tax. Okay, the idea is always to plan in advance to avoid any unnecessary tax bills. Okay, in terms of then how the UK taxes, well, there's different levels. So all earnings and pensions are taxed in the UK. That also includes annuity income. So Hong Kong doesn't tax annuity and pension income. The UK very much does. Hong Kong has property tax. The UK taxes rental income in the same way. Now, when you're in Hong Kong, that's the only taxes that you need to be concerned about. If you move to the UK, then you need to think about a few others. So firstly, is savings income is taxed, so any kind of interest or coupons on bonds or anything like that, fully subject to income tax. All dividends are taxed. It doesn't matter whether from a private company or a public company or even from an equity income fund. On top of that, insurance policy gains are taxed. Now, they're subject to a very benign tax system that Howard will cover later, called the chargeable event rules. And then on top of all of that, you have capital gains tax, which capital gains are not income, but they're taxed in the same way. So let's look at what the actual rates are. Now, I've heavily simplified this because the UK has lots of reliefs, exemptions, and so on. So this is just a broad picture of it as well. So the income tax rates are on different bands of income. Broadly, the first 50,000 sterling of UK income and any income that you remit from Hong Kong to the UK, 20%, and then it goes to 40 and then 45. Capital gains tax rates are different, and they're different on property than from other assets. Those are the rates currently, 18 and 28%. And then other assets such as stocks and shares and so on are taxed at 10 and 20%. Okay, now let's look at some actual numbers. So if this is your income and these different bands, this is the actual amount of tax that you will pay, because you'll pay some at 20%, some at 40, and some at 45 if your income is high enough there. So if you average those out, there's your effective tax rate. Okay, so that's the tax that you'll pay on your total income. Okay, so the remittance basis then. So this is a very good thing because if you don't remit income and gains to the UK, they won't suffer UK tax. It's very important to say that it's very easy to make a remittance without realizing it, and these are the traps that people fall into. It also doesn't just apply to you as the taxpayer, it applies to people that are connected to you, and I'll cover that in a second. Okay, so these are the potential traps you can fall into, and it's important to point out, and you'll see why, that your banker back here in Hong Kong will need to be given very clear instructions about how to manage your accounts once you've moved to the UK. But there are UK planning solutions that solve all of these problems. So what comes up now, you might think is bad news. Don't worry, Howard is going to show you some solutions at the end that deal with it. So what is a remittance to the UK? Firstly, any transfer of money into the UK obviously is a remittance. So you've got a bank account here in Hong Kong and you send money from your Hong Kong bank account to your UK bank account. That's obviously a remittance. It's also in the form of cash. So if you go to the ATM here in Hong Kong and then take cash with you into the UK, that is also a remittance. That's taxable. Okay. Also, not just cash, any items that you buy with your non-UK income and gains. So let's say you come back out to Hong Kong and you see a nice painting, you think that would look nice on the walls of our apartment in London. You buy the painting in Hong Kong with your Hong Kong income and you physically take the painting with you into the UK. That is a taxable remittance of the amount of money you spent on that painting. And that's going to be taxed. So, and it's any item where you pay more than £1,000 sterling. Anything you spend more than £1,000 on, could be an expensive laptop, it could be anything, that is a taxable remittance to the UK. The only exceptions are items you can wear. So jewellery and watches, clothing and footwear, they're exempt. So watches are okay, but anything else is going to be taxed. Probably the most common trap people fall into is using their Hong Kong credit card in the UK to pay for their lifestyle and buy things, and then paying the credit card bill here in Hong Kong. The amount of a bill that you pay here is a taxable remittance to the UK and will be subject fully to income tax. If you take out a mortgage in Hong Kong to buy a property in the UK and then you pay the mortgage here in Hong Kong, those mortgage payments are a taxable remittance to the UK because the property is in the UK. There's a UK connection there. And then also, if you take out a loan from a bank in Hong Kong and you use that loan to fund your lifestyle in the UK, the bank will probably ask you to put up something as security for the loan. Whatever you put up as security, the value of that security is a taxable remittance in the UK and fully taxable. Even worse, if you pay the loan in Hong Kong and service the loan here, that's a second remittance. So you'll end up paying tax twice if you use a loan from a Hong Kong bank to fund your lifestyle in the UK. So all of those things are remittances into the UK. But there's more. If you have services provided in the UK, so again, a very common example for people with children. So let's say that you're in the UK with your children and they go to a fee-paying school. Now, clearly, if you remit Hong Kong income to the school in the UK, that's a remittance, okay? Now, some schools in the UK think that they're quite clever and they go, oh, you're from Hong Kong, you've got an account in Hong Kong, so do we. So instead of sending the school fees to our UK bank account, why don't you pay them from your Hong Kong bank account to our Hong Kong bank account? I'm afraid that is still a remittance to the UK because the service is provided in the UK, namely the education of your children. The fact you pay for it in Hong Kong doesn't matter. The amount of those school fees, even though no money has gone into the UK, there's a service provided there that is a taxable remittance in the UK. And again, it's a very common trap people fall into. Okay, any flight that you take that either lands in the UK or takes off from the UK to anywhere else in the world, not just Hong Kong, anywhere, if you pay for that flight with your Hong Kong income or gains, that is a taxable remittance because the plane has entered UK airspace. So you imagine you take a business class trip from Hong Kong to the UK with your partner and children. The total cost of all of those flights is a taxable remittance to the UK. But it's not only for anything that goes into the UK for your benefit, it's for the benefit of what's called a relevant person, another one of our technical terms. A relevant person is you, it's any partner you have. You don't have to be married, it's just someone you're living with. Any children that you have under the age of 18. So again, if you're paying for your kids' school fees, your child is a relevant person if they're under 18. But it's not only children, it's grandchildren as well. So if you're in the UK and your grandchildren are going to school in the UK and you're paying their fees, that's a taxable remittance on you. It also applies to any company that you're a director of or a shareholder of, and also any trust that you are party to as well. So they're very, very comprehensive, wide-ranging rules, and people fall in the trap all of the time. Okay, so what types of remittance are there? It's important to understand this. The first one is what's called clean capital. I'll explain what that is. Clean capital is not taxed if you remit this to the UK, and there are some significant advantages there. Any form of income, though, is taxed, whether it's interest, dividends, rental income, that's taxed. And any form of capital gains is taxed as well. In reality, most people have a bank account that's got a mixture of all of those different types of money in it. And that's what's called a mixed fund. And if you make a remittance from a mixed fund, it is taxed. Now, so let's just talk about what clean capital is. Before you become UK tax resident, all of your assets are clean capital. But there's a massive change on the day that you become a UK tax resident. And remember, that can be before you physically arrive in the UK. It could be the previous 6th of April. From that point onwards, probably last April, clean capital can only be cash and a particular type of cash. I'll show you an example there. Anything else you have is potentially taxable. Now, if you've got a bank account that's got a mixture, and that mixture arose after you became UK resident, it's called a mixed fund, another technical term there for you. Okay, so if you make a remittance from a mixed fund, it won't be clear what it consists of. So how much of that remittance was capital, how much is income, how much is gains? So because it's all in one account, and once the cash goes in there, it's all mixed up. So for that reason, they apply the ordering rules, another technical term for you. And I'll show you an example there. And these are pretty disadvantageous, so you need to be careful with them. So here's an example here. So Eleanor's living here in Hong Kong. She's got an account with 10 million Hong Kong dollars in it. She's non-UK resident at this stage, so this is clean capital. So she moves to the UK, her tax residence begins. So she actually moved to the UK in the August of 2020, but her tax residency was backdated to April of that year. And she obviously is going to use the remittance basis because it's the first 7 years, there's no charge for it. Now, on the 30th of April, Eleanor's still in Hong Kong at this point. She hasn't moved to the UK yet. The bank adds the interest to her account. So, so that makes it a mixed fund. That's what's called tainting it, because it's got a mixture of the original 10 million clean capital and then the income, which is the interest. So it's all cash, but there's two different types of cash in it, and you can't unmix them. She's still living in Hong Kong at this point. She hasn't yet gone to the UK. So it's a mixed fund, and the bank doesn't even know that Eleanor's moving to the UK. She hasn't told them yet. So they don't know what they've done and what the consequences are. But here's what the consequences are. So there's the clean capital, because she's non-resident. There's the interest, which they add to the capital account. That makes the whole thing a mixed fund. And once it's mixed, you can't unmix it. So Eleanor's still in Hong Kong, but just in advance of moving to the UK, she decides to send some money from a Hong Kong bank account to a UK bank account, so that when she arrives in the UK, there'll be some cash there for her. So she remits $500,000 Hong Kong dollars, okay, to the UK. Now, we have to apply the ordering rules because they came from a mixed fund. The ordering rules dictate that all of the 200,000 interest went first, so it's not proportional. All of the interest has gone first, so 200,000. The remaining 300,000 is clean capital. Therefore, the 200,000 is subject to income tax. So Eleanor's going to get a tax bill of about 40,000 Hong Kong dollars. This was completely unnecessary. What we should have done was this. There's our clean capital account. There's our interest. Don't add it to the clean capital account. Set up a segregated, separate interest account and pay the interest into that one. And don't send any money from that account to the UK, because that's going to be taxed. But what that does do is keep the 10 million as clean capital. You can then remit any amount up to 10 million to the UK without paying any tax. So that's what Eleanor and her bank should have done, but they ended up with an unnecessary tax bill. Okay. in terms of the value of the remittance then. So Eleanor's gone to the UK, but she's still got business interests and friends and family in Hong Kong. So one of her friends starts up a company and she thinks it's a good idea. So she transfers $1 million of her Hong Kong income to invest in the company. Now, no problem so far. Nothing's gone to the UK. This is entirely a Hong Kong transaction. Unfortunately, though, the company doesn't do very well, and it basically fails. So she decides to get back what she can by selling her shareholding. She only receives 20,000 Hong Kong dollars back. Okay, now she thinks that's not very much money. Only 20,000. I'll remit that to the UK. The problem is with the remittance basis is that you have to trace the 20,000 Hong Kong dollars back to where it began. Okay, and it began life as $1 million of Hong Kong income and gains. So even though she's only physically remitted 20,000 Hong Kong dollars, the amount of the taxable remittance is $1 million Hong Kong dollars. Now, this is completely crazy, but this is the remittance basis. This is the law. And this catches an awful lot of people with a very, very unpleasant surprise where you get a tax bill for $1 million Hong Kong dollars and you've only remitted 20,000. Okay. Now, some people say at this point, how are they ever going to know that I've remitted money? Well, since 2017, we've had something called the Common Reporting Standard, which is how tax departments around the world exchange information. So Hong Kong, the UK, all these other countries do it. It's over 100 countries. Let me just show you very quickly how it works. So here's Peggy. She's living in Hong Kong. She happens to have an account with a bank in the UK that pays interest. So because she's living in a different country to the bank, she's in scope for the CRS. So the bank has to report the account information to the local tax authority, HMRC, and it's all of those details. HMRC then, on an annual basis, exchange automatically all that information with the IRD here. Now, because Hong Kong has territorial taxation, the IRD doesn't care about a bank account outside of Hong Kong, so no problem. What happens, though, if Peggy moves to the UK? Now, she's still got financial accounts back here in Hong Kong with banks, insurance companies, stockbrokers, asset managers, and so on. They will all have to report the existence of those accounts to the IRD. And again, it's all the comprehensive information. The IRD will then exchange that information backwards with HMRC. Now, Peg is living in the UK. She's a UK taxpayer. She has to do a UK tax return. If the information on a tax return is different to the information that the HMRC receive, she's going to be investigated by HMRC. So that's how they can find out. The other thing is HMRC have got an analytical tool called Connect, which has got 22 billion lines of data in it. It's more information than is contained in the British Library. And every year, Connect throws up about 500,000 cases of where HMRC thinks somebody is not declaring their taxes correctly. So what they do is, and they're quite secretive about this, but these are the different sources of information that they have owned up to. There are some that they haven't told us about. So the first one is HM Land Registry. So every property in the UK is registered with the owner where they are. So that if you own more than one any UK property, they'll know that. And if you own more than one property, they'll be expecting that one of them is being rented out, and they'll look for that rental income appearing in a bank account somewhere. If it doesn't, they'll be asking questions. So, and they can get that information from all the estate agency websites, which they monitor. They also get all the data from things like eBay, so they can see if somebody's effectively running a business from home and trading. They can see what car you're driving. So if you're declaring a very low income, but you're driving an expensive car, that will flag this up. And the important point is, this is a machine doing this. This is not a human being sitting down. This is all done with algorithms and machine learning and artificial intelligence. So it flags it up. They can see all the flights that you take. They know where you're flying to, which airline, which class you're flying, and so on. They scrape data from all of the social media websites, because someone, buys themselves a new watch, takes a photo of it, puts it on Snapchat or whatever, they'll be able to tie that up as well. They also get access to all the credit card information as well. So those are the sources of information that they have admitted to. As I say, about 500,000 people a year have got differences between their declared lifestyle and what HMRC can see about them. Okay, so finally from me then, there is a double tax treaty between Hong Kong and the UK, and this is designed to stop you paying the same tax twice, which is a very good thing. So these are the taxes that it covers. So in broad terms, if you've paid Hong Kong tax on Hong Kong income and you then remit the rest to the UK, it won't be subject to UK tax. But let's say that it's property tax here, which is, let's say you've paid 15% here on that. But in the UK, your total income takes you into the 40% income tax bracket. So you get your rental income from Hong Kong, you pay some 15% tax here, you remit the rest to the UK, you'll get a credit for the 15 you've already paid, but you're a 40% taxpayer. You'll have to pay another 25% tax on that same income in the UK. Okay, it's to prevent tax twice, not preventing tax altogether. If it's something where that you've paid no Hong Kong tax, so interest, dividends, capital gains, and you remit that to the UK, that will be fully taxed in the UK. And there's a link then to the website there. Okay, I'm now going to hand back to Howard, who has the good news.
Hello all. Well, the obvious question is he still motivated to move to the UK? And you can possibly see why some of us moved to Hong Kong. But there is more to it than that. So let's have a look at some of the areas we can help. So the key is to do financial planning and get some ideas on that before you go to the UK, and ideally before the tax year that you go to the UK. So this is really looking at next tax year, 6th of April 2022 onwards. Now you can do split tax years. You can make applications upon arrival for a split tax year. So halfway through they can split it for you, but there's no guarantees you're going to achieve that, and you know that therefore you could be taxed right back to the 6th of April of this year. But you know, again, we can look at that, can help you make those applications if you need it. Now, so the issue here is really distinguishing between clean capital, income and gains, and that's probably the hallmark of everything we're talking about. Because if it does mix up, and it's so easy to mix it accidentally most of the time, because I've heard HSBC doesn't like setting up segregated accounts to redirect your interest into, and then therefore the probability of making them an accidental payment is very high. Then in that instance, you can pay up to 45% in tax on anything that you remit back to the UK, what you thought was clean capital. So and the important thing is you can't unmix that once you're in the UK. So creating separate accounts is important, but it's not foolproof, as I was just saying. So we need to look at things in a different perspective and different ideas. So pre-immigration financial planning is important. So here's some ideas. Now, if you've got enough clean capital to survive the whole period of time while you're in the UK, so you've got enough money for your life in the UK, you needn't really be too concerned. You can just draw down on that or transfer it into the UK, so long as it's never accidentally mixed and therefore creating problems for you. But, you know, if you do that, it has to stay in cash, and there's no other form, and therefore you lose the opportunity cost and likely be eroded on inflation over time. So 10 years worth of inflation is having a massive impact on the purchasing power of your money. So people normally like to invest it to try and at least beat inflation. And in that case, it's no longer cash, therefore no longer the clean capital definition. So, and there's many other scenarios here. You may need to supplement it. You may need to transfer some income on top of it. There's a lot of other areas that could come up, and therefore we need to consider before you move. So first thing is capital gains. Now, here's an example here. Two sisters, Anne and Charlotte Lau. They bought Tencent in 2016. It's a lovely investment, I'm sure you all know. There's 500,000 turned to 1.67 million in April 2020. It did fantastically well. After 2 years in the UK though, they moved to the UK in April 2020 as well. So after 2 years though, they decided to settle there and they want to buy an apartment. They haven't got any clean capital, so they need to remit some capital gains. And Tencent, meanwhile, has dropped back to 1.6 million, so they decide to use those and sell some shares to send to the UK. Nothing wrong with that. People do it all the time. But the tax they pay is the issue. So first one is Anne. So she simply sells it, and you can see the calculation here. That she's made a gain of 110,000, so she pays 22,000 pounds, which is 220,000 Hong Kong dollars in tax. Charlotte, though, she took a little bit of financial advice before she went. She actually sold her 10-cent shares just before she went to the UK, but bought them back. She made a gain on those shares, as we know, 500 to 1.67 million. But in Hong Kong, there's no capital gains tax. So therefore, all she paid was 3,000 Hong Kong dollars in stamp duty. Now, in the UK, when she took the money to the UK, because she actually made a loss because the shares have gone backwards, 167 to 160, there's no capital gains tax. So simple things like that, it's called washing your gains before you go, is something easy and can be done for everybody. Now, we're in the world of trying to make things simple. So we try and create a structure that's robust and lasts time that you can draw money from. Now, the ones that seem to last every change in taxes over the years are insurance contracts. Why? Because people want you to be in, governments want you to be insured. So if you hold things, and why is it useful here is if you hold things personally, they are subject to tax. Income, you've got things like dividends, interest and rent, that's all income tax, capital gains, even investment portfolios you're running. People don't often realize whenever you sell something and then buy something in the portfolio, that can create gains and therefore a tax bill. So if you place it inside a wrapper or what we call an envelope, and that can be an insurance policy, all other forms like trusts and corporate structures are pretty much see-through these days. You can transfer the ownership to an insurance company and not in your personal name, although you remain the beneficial owner. Now, the private banks call that a PPLI, private placement life insurance, but the real name is a portfolio bond. There are advantages in doing that. So first of all, it's referred to the UK to see what they say about that. This is the government from their website, and you can see here it is. You can look it up. There's the links for you, and you'll get a copy of this presentation afterwards, so you can follow these links and read it yourselves as well. And there's the portfolio bonds. So here, what it basically says is, I highlighted here, because it's enveloped from a life insurance policy, the policy holder, which is the client, do not have to pay tax on inside of anything that happens inside the policy. So all the tax, you don't need to worry about it until the policy comes to an end. Right? Now it comes to an end if you pass away or it's fully surrendered. Okay. And meanwhile, all the income inside the policy, everything you hold is, sorry, where was I? All the things, if you held the assets in your own name and not there, you'll be receiving up to 45% in taxes, whereas in a policy, it's no taxes. And in all the gains, you can have up to 80% of them because of 20% taxes, whereas you'd have 100% inside the portfolio. So this lack of tax paying is called grossing up your gains. So what could be held? What could go inside them? Well, lots of things. We're pushed for time, so I won't dwell on it too much. But what I will say is actually the tax obviously goes up to the owner of the policy, which is the insurance company. But because it's in the Isle of Man is like Hong Kong. There is no tax on dividends, interest, or any gains, and therefore no tax for an insurance company to pay, and therefore no extra cost to pass down to the policy holder either. So it's nothing unusual, untoward. It's just taking advantage of different tax jurisdictions and the rules. So existing portfolios, won't dwell on this, but we can literally transfer them or wrap them in an insurance policy, and therefore you can maintain your existing private bank account or online platform and manage it that way, but take all the benefits of an insurance wrapper, the tax benefits of an insurance wrapper. So what happens if you want to withdraw money is the crucial bit. Now, again, let's go back to the government website for this and look at how they view if you want to take money out. So you could take 5% per annum out of the premium, so the amount of money you invest in there, without a technical gain happening. Okay. What that means is you could draw down into the UK while you're living there 5% per annum and effectively not pay tax on it. In addition to that, if you don't take it 1 year, you can carry it forward to the next year, which is here saying you could draw 10% the second year if you don't take 5% in the first year. And likewise, if you take 4%, you can take 6% the next year and so forth. Now, what that means is if you take 5% per annum, it can last for 20 years because 100% divided by 5 is 20. And but if you only take 4%, if you can live on 4% of your money, it could last for 25 years. If you can survive on 3% of your money, you're going to last for 33 years with no tax on those of that income you're taking into the UK. So it becomes a very good supplement or your source of income for the UK. Now, the key thing is it has to be funded from clean capital, i.e. the money, the cash, the money gains you have in Hong Kong before you become a resident. And anything above 5% is technically taxable, although we can create things like mini policies that we can manage that tax rate by cashing in sub policies, and that makes it even more tax friendly. And let's go through. So let's give us a couple of examples of how this all works. So again, let's have a look at Bella and Claire Wong, sisters in Hong Kong, planning to move to the UK. They got quite a bit of money before they went. They got 50 million Hong Kong dollars each. They sold their properties and they had a few savings. And we're assuming here that portfolios only grow by 5% per annum, net of fees, and it's a combination of income and capital growth. They plan to stay in the UK for 5 years, so they believe they're going to need 120,000 pounds or 1.2 million Hong Kong per annum to live in the UK. So what they do is slightly different, each one of them, but let's run through it. Bella, she decides to set aside 600,000 pounds, which is 5 years income in clean capital in her bank. As I said, that could be in the UK or Hong Kong. The interest is paid into a separate account to avoid mixing it, and the remaining 4.4 million is invested into a portfolio, and she remits 120,000 of the clean capital year into the UK and pays no tax. After 5 years, her portfolio is 5.6 million. And she's got another 36,000 in income. So she's got 5.651 million pounds. Claire, she puts the 5 million pounds into a portfolio bond. She's fully invested at that time, which is the big issue about the opportunity cost of holding cash or not. So she makes withdrawals of 120,000 pounds a year, and it's within her 5%, so that's not taxed. And her portfolio bond is 5.718 after 5 years. So it's another 60,000 pounds, 600,000 Hong Kong dollars, because she was fully invested and not just purely holding cash and losing the opportunity cost of cash. Oh, sorry, 100. Yeah, I got my maths wrong. Trust your financial advisor, they say. Right, scenario 2. Let's say somewhere along the line, there's sort of anticipated need for some cash. So they both need to buy an apartment in 3 years. So they both want 500,000. And what can they do about it? Well, Bella, she's still got 240,000 left. She spent 3 years of her 600. She's got 240,000 left. So she can use this as a deposit and then transfer the balance in if she wants. But, you know, she still needs to remit 260 anyway to make up the difference, which is what would her income be for the next year, the next couple of years. So she decides to remit the whole amount instead. But it's got to come from a mixed portfolio because she was investing it, and therefore ordering rules apply. And it's very disadvantaged. Basically, the most expensive tax you pay first on the amount, and then it goes down to the next expensive one, then it goes down to clean capital. So for her, she had to transfer, after her calculations, she had to move 881,000 pounds to get 500,000 net of tax, which is 381,000 in taxes, nearly 4 million Hong Kong dollars in taxes on her money to move it to the UK. Now remember, when you buy that property in the UK, you've got a lot more taxes to pay in the UK on top of that, like stamp duty and all sorts of others. So you get cleaned out quite nicely on taxes. Now, Claire's 5% allowance is actually 250,000 a year, and she's only taking 120,000. So she's left with 130 of unused. And remember, you can carry that forward. So in the 4th year, which is what they're looking to do, the unused allowance is 520,000. So she decides to use that and take that straight into the UK for a deposit and pay no tax. And she doesn't have to pay any or complete any annual tax return, which is quite a pain if you've ever done one before. So another scenario though, they both decide, well, we actually like the UK now, we want to stay here a bit longer. So Bella continues, she's now remitting, not from clean capital, but from a mixed fund. She's got to pay taxes. For her 120,000, she's got to move 190,000 and pay 70,000 in tax a year. 750,000 Hong Kong tax a year just on that. Claire, by the way, she's still juggling along. She's got, because she's only 120,000 a year, which is less than 5%, she can draw down for 32 years and not pay tax on it. So she's fine. She's just continuing the way she was before. Now, after 7 years, things start to change. Bella now has to start paying 30,000 a year on top of her tax bills. Right? Now, each year she needs to make a decision, and in her instance, because she has significant money offshore, she decides to stay with remittance basis, because you can move to a rising basis, but you lose a lot of the capital gain shielding offshore. Only worthwhile if you work out the taxes, and normally it's the tax-free rate, the limit, the nil rate band is the main benefactor of going to a rising basis. Her portfolio is now 4.8 million, and she's paid over 500,000 in taxes so far, i.e. 5.5 million Hong Kong dollars. That's quite a lot. Claire, no change, struggling along. She's now 600,000 pounds, 6 million Hong Kong dollars better off than Bella's portfolio. She's paid 0 taxes, and she doesn't have to pay the 30,000 a year. 12 years, it gets worse. Bella now has to start paying 60,000. This is what was said by Jason earlier. Now, luckily, her portfolio is back to where it started, 5.6 million. But remember, the inflation, it's actually worth less than what it is in real money. Because she's paid £1 million or 10 million Hong Kong dollars in taxes. Claire, no change. She's now 13 million Hong Kong dollars better off than Bella. No tax, no need to pay the 60,000 or add it to her annual personal tax returns. Now, 15 years, Bella becomes a domicile person, deemed domicile, no choice. And lucky to last 15 years. There's many cases actually where that deemed choice happens before 15 years at the decision of HMRC, but say it lasts for that period of time. So now she becomes domicile, global taxes to start to be paid on all her income and gains. And so therefore she has to start paying tax not only on her income in the UK, but globally in the world, i.e. her portfolio in Hong Kong. So now she's paid 1.4 million in taxes so far. Claire, again, nothing's changed, but now nearly 20 million Hong Kong dollars more in her personal balance sheet than Bella's. Okay, now the classic scenario often happens if you go into different countries and meeting local guys. In this instance, they decide to get married after 6 years in the UK. Now, when that happens, you know, you become a domicile of choice. It's out of you can't make choice. The HMRC says you are now domicile. So Bella, she has to go a rising basis after 6 years. So quite an expensive decision there to get married. And start paying that 70,000 in tax from the 6th year onwards. And don't forget tax on all our offshore gains in Hong Kong as well, which is not in this presentation, but it's even more tax on top. Claire, she's great. She's got 31 years left of income without having to pay tax if she wishes. Maybe she can increase the income a little bit, so therefore have maybe 28 years or 27 years left. So summary, UK tax is complicated and high. We like to simplify things. The remittance has certainly got an awful lot of advantages, but it is complicated, and there's a lot of easy traps, for accidental traps outside of your control. Sometimes it's with your bankers that people fall into. And you need to work out once a year whether you want to stay on remittance or not. That's a complicated task. You need an accountant normally to work with you each year on that basis. But using an insurance policy can keep things simple for the amount of money that's in your insurance policy. What we find is people maybe use insurance and remittance as 2 different ways of doing it. And the key is to take advice, really take advice before you go. There's a lot of stuff online, but it's very easy to miss a lot of stuff. So I know people researching, they're going through it, but they miss things like CRS or Connect or the hidden ways, the traps. So it is important to take advice on this. So that brings us to an end today. You will get a copy of this afterwards. And I've got a question in, so ready, James? Right. For mixed funds example, you talked about what is the catch on using the split rule? We are moving in August, and is there anything we can do to set up clean capital now?
Okay.
I suppose I mean that split tax year.
Yeah. So if you're moving in August, yeah, you're going to be in the UK for 8 months, so you'll be automatically resident. It all depends upon whether you can claim split year treatment, so that the period up until August is treated as a Hong Kong residence, and the period after August is UK residence. I'd need to know a bit more about your individual circumstances to be able to give you an opinion whether you could claim split year. It's possible, but it's quite difficult and quite complicated. If you want to contact Howard via the details on the slide, and we can just ask you a few questions about your circumstances, and then see whether we'd be able to help you gain split year treatment. If you can't, then it could mean quite a nasty surprise. So we'll obviously do whatever we can.
Yeah, no, we'll help you out on that one, Richard. But there are 8 categories and subcategories within each one of those 8 categories for the split tax year. So it needs to be worked through.
Yeah.
So we'll revert back to our advice to do it the year before. But if you can't in your circumstances, Richard, yes, let's sit down and talk about it a little bit more.
Definitely.
Okay. Any other questions? Oh, another one's come in. Oh no, it's Richard saying thank you. Okay, thank you indeed, Richard. Now, so again, what we'll do is we'll follow up, we'll send you copies of this to you, so you'll be able to go through it slower in your time again. Our contact details will be on the emails and obviously in the presentation as well. And we look forward to hearing back from you. Take care, and once again, thank you for sacrificing your lunch and listening to us too. Take care. Goodbye.